Do you know how long the long term truly means in the world of mutual fund investment? Is it 5 years, 10 years, or 15 years? Let's try to find out based on historical data analysis. We have all heard this rule where 15k invested per month for 15 years at 15% returns gives us portfolio of 1 CR. But let's verify its claims based on past data. This one is one of my favorite. Do you know how many actively managed mutual funds really beat their benchmark? Let's see the facts through rigorous analysis. Also, I will analyze various NSE indices and their performance. And finally, I will analyze passively managed mutual funds, their types and performance so far. And last but most important, what if I told you that CAGR returns are deceptive? Yes, you heard it right. CAGR returns are deceptive. So in this video, we will dive deep into why these traditional metrics do not tell the whole story. I will try to find the answers to these questions purely based on historical data. Let's get started. Now firstly, let us set the context right. This is not a financial advice. Past performance does not guarantee future results. Investment certainly carry risks and there are no guarantees on returns. Aim of this video is to raise awareness among retail investors like us so that we can take informed decisions in our investment journey. And that's why all the data sources, methodology used in this study is shared so that you can recreate this at your end to gain more confidence. Now first look at the CAGR returns for Nifty 50 rolling returns for 15 years time frame. So before going ahead, let's first understand this plot. So this plot is all possible 15-year CAGR returns on Nifty 50. So on y-axis it is percentage returns. On x-axis it is the timeline. From we have results almost from 2005 to 2024. So how we have plotted this? So we have first collected Nifty 50 data all the way back from 1990 to 2024, and then we calculated the first data point, which is represented here. So in this case, uh, the investment was done in lump sum format in 1990, July 1990, and end date was July 2005, and we got compounded annual growth return of 14.8%. Similarly, this is the last data point. So total data points we have is 4608 data points. This is last data point. So here investment date was starting date was February 2009 and end date was February 2, 2024, and we got CAGR returns of 14.9%. Now let's look at the SIP returns. So these are SIP returns for the same Nifty 50 for the same time frame of 15 years. So let us understand this plot with example of starting and end data point. So this is our data point 1, but in this case instead of investing in lump sum, we started a SIP of same value for on the same date July 1990, and finally in July 2005 we saw a SIP returns, that is XIRR returns of just 10.9%. Same for the last data point, that is when we started the SIP is on February 2009 and we saw our returns in February 2024, and we saw our SIP returns are 12.6%. And note that we are assuming here that we have maintained a constant value of SIP and we have not missed a single investment, monthly investment during the duration of 15 years. You may have already noticed it. The plot of CAGR, rolling CAGR returns and rolling SIP returns is looking to be slightly different. So let us plot them together to understand the difference. Now when we clearly overlap them on a single plot, it is clearly visible that there is no specific pattern or trend between these two returns. And we can see they are the difference between two is also not uniform across the timelines. So for that, let us plot the difference between the two curves. So these are the reference points that we earlier checked in order to understand the curves in a better way. Now when we plot the difference, we see the variation in CAGR and SIP returns is anywhere between minus 7.5% to as high as 5%. But what does it really mean? Let us understand this with one example. So let us take this case itself. So this case represents a person, okay, who started a SIP in 2003, long back, so 15 years back, 2003, and he is checking his returns in 2018. What he found out was his mutual fund CAGR returns was 17.5%, but his actual SIP investment is just 12.4%. And that is why I say CAGR are deceptive, because SIP returns is what exactly retail investor like us will get in reality, but CAGR are deceptive. And I'm not saying 12.4% are bad returns at all. They are also decent returns. But the point that I'm trying to make is CAGR returns are deceptive. And let us understand this, why they are deceptive. So for that, let us take case 1 as lump sum case. So we have our beginning value as 100 rupees and we have ending value as 124 rupees, and it has increased to this end value in 2 years. So it is very easy to calculate the CAGR return using this formula, and that comes out to be 11.4%. And now for case of SIP returns, let us take these three curves of NAV changing from NAV of the mutual fund changing from 100 to 124, exactly same in 2 years. So you can see we have this plot is for somewhere in January 25th January 23 to 25th January 25. Now let us take case 2. So everything else is same as case 1, only changes instead of lump sum investment we have started a monthly SIP of 100 rupees, and after 2 years we are checking the returns. Now a point to be noted here is the NAV of the mutual fund has followed the blue curve, that is the straight line. So let us evaluate the SIP, that is XIRR returns for this case, and that comes out to be 10.9%. Now case 3 is exactly same as case 2, but only difference is the NAV followed yellow curve instead of blue curve. So in this case, if we evaluate our SIP returns, that comes out to be 16%, 6% higher than our earlier case. Why this has happened? But before that, just we will complete the last case, that is fourth case, where the NAV followed the red curve. And you will shock to see our actual SIP returns are just 6.3%. The reason behind this difference is the XIRR returns also takes into consideration the each investment you have made at all the months in between. So when you started the SIP, you invested strictly at every month on the same date, huh? And you buy the mutual fund units based on the that particular current NAV of the mutual fund. So it takes into account all your investment and then finally gives you the return. But in case of CAGR case, note that in all these cases, if we try to calculate CAGR for all these three cases, case 2, 3 and 4, it will come the same, that is 11.4%, because CAGR doesn't consider the intermediate investment that we do during our investment time. So that is the fundamental difference between these two. So now let me ask you, in case of retail investor like us, which who usually prefers to invest on monthly basis, which return metric we should consider? Is it CAGR or is it SIP or XIRR returns? I think we should consider SIP returns, that is XIRR returns. Why? Because we never invest as a lump sum. Even though for longer duration, we always prefer to invest on monthly basis. And this is my proposition for the uh, why I'm saying that CAGR are deceptive return metrics. But you just take a step back and recall, when was the last time you selected the mutual fund, which return metric you chose to compare? It is always CAGR, because no web commonly used web portals and app does not show the SIP returns. They always show the CAGR returns. I have found one better alternative of understanding these differences of difference between CAGR and SIP returns from our earlier concept that we have learned in physics thermodynamics, that is state function and path function. So simply CAGR is state function. It just takes into account the end value, the end state and initial state, and it calculates gives us the CAGR. So common examples of state functions are temperature and pressure, and in financial world, CAGR is also state function. And similarly, SIP or XIRR return is path function, because it takes into account each individual investment or each individual contribution we have made into our investment, and finally gives us the actual return on our investment. So it is very easy to understand from this. SIP and XIRR is path function, CAGR is state function. So just to summarize, indeed CAGR returns are deceptive. And what we observed for Nifty 50 case, that if we plot rolling 50-year returns, the difference between CAGR and SIP returns is -7 to 5%. So it makes sense to compare investment instruments like mutual funds on SIP return basis rather than CAGR basis for retail investor who invest on monthly basis. We have to also consider the fact that there are very less available historic SIP returns on any portals, be it famous commonly used websites or apps. The reason behind this is rolling CAGR returns are easy to calculate, even in Excel. We just have to download the historical prices of them, and it is very easy to calculate because it just takes into account two values, so we can calculate in even in Excel. But rolling SIP returns, that is XIRR returns, are slightly tricky since it involves few more steps to calculate, which makes it complex. So I'm not saying it is not possible to calculate XIRR returns in Excel. You can do it for one case, but to able to do it for this longer time frame, having data points more than 4,000, that makes it really complex. But anyways, so in our case, in our this analysis, now onwards, we will use only SIP returns for all our upcoming analysis. Now let's understand how long the long term really is in mutual fund investments. Now for this, we will use this plot, uh, which is known as box and whisker plot. Firstly, don't get confused with the candlestick charts. This is not a candlestick chart. So basically, box and whisker plot is used to summarize a set of data. Hmm. The shape of the box plot shows how the data is distributed, and it shows also any outliers are there or not. So it is useful to compare different sets of data, as you can draw one or more than one box plot per graph. So in this box plot that we have drawn, this yellow line represents median of the data set. The region inside this pink box represents 50% of the data set. And the region between these whiskers, one on the left side, one on the right side, represents 99% of the data set. And there could be some outliers which are outside the whiskers. They represent any exceptional cases if we have in our data set. So this plot we will use uh, to uh, to find how long the long term really is. So for this, First, let's understand how we have uh, built this plot. So we have taken Nifty 50 data all the way from 1990 to 2024, uh, and we have find all possible 3 years SIP returns on in this last 34 years of data, and we found out there are 7,500 plus data points, and we plotted those in the form of this box plot. So what you can see is there is a huge variation in the returns, all the way from minus 22% and as high as 50, almost 50%. This green line represents the 7% return line. So then it will be easy to see where our returns are with respect to this 7% line. So similarly, we have also plotted another box plot for all possible 5 years SIP returns from 1990 to 2024. Similarly, for 7 years, you see the trend which is setting. So as we increasing the number of years in our SIP, the variations that are we getting in our SIP are reducing. So at 7 years marks, you can see complete box of this box plot is above 7% line. What does it mean? It means more than 75% of these data points gave us more than 7% return. But still, there are 25% chances, looking at this region, that we got less than 7% returns even after 7 years of mutual fund investment. Let's see the case for 10 years and for 12 years as well. So here you see this box completely is above 10% line, and for the first time. But see, you can see there is considerable region which is still below the 7%. So that's why let's see the plot for 15 years as well. And finally, at 15 years mark, we have almost all our 99% data points having more than 7% return. And one thing to note here, as we increase our SIP duration, the data points keeps on reducing. So for 3 years case, we had almost 7,500 data points, but for 15 years case, we have just 4,600 data points. But as I said, there could be some outliers. So these red markers, all in all these cases, represent the outliers. So even after 15 years, there could be chances, exceptional events can happen, and where you can get less than 7% returns even after 15 years. And as there are outliers on the downside, there are outliers on the higher side as well, which are represented by green mark. So from this plot, it is now very clear to us how long the long term really is in the world of mutual fund investments. At least to me, it is 12 years. Because at this time, at this after 12 years, we can see considerable chunk of this returns are above 7%, more than 75%, they are about 10%, and that is what we expect in longer time. So it makes sense to have our mutual fund investments at least for 12 years. Now you know this rule. This rule is very simple. 15k SIP for 15% returns for 15 years, and your corpus amount will be 1 CR. Now let us look at this plot from our previous analysis. This is 15 years rolling SIP returns of Nifty 50. Yeah. This pink line denotes 15% cutoff, and you can see only 30% of the time returns are above 15%. It is clearly visible, and rest 70% cases returns are below 15%. Point number one. Now next point, you will shock to see average holding period of mutual fund units in India is less than 5 years. Just Google search it and you will surprised to see the average holding period of mutual fund units is less than 5 years. Now if you factored in these two observations into this rule, then chances of getting 1 CR are very less. It is very easy. Now this one is really funny. There is a superstition that there are some special dates in a month on which if I start my SIP, then I will get higher returns. Complete nonsense. See this plot. Again, a box plot for all returns for all possible dates in a month from 1 to 31. Now here green mark represents average returns and orange line represents median. You can see for all the dates they are more or less at the same level. So what it says is there are no special SIP starting date, and if someone is telling you no, you can invest on these dates and you will get more returns, it's complete nonsense. Now in this section we will analyze how many actively managed mutual funds really beat their benchmark. So currently there are 400 plus equity mutual funds in India. They are categorized in several subcategories. So one of which is large cap mutual funds. So in this mutual fund, the fund manager chooses the stocks only from mostly from large cap, and they are benchmarked against the Nifty 100 index. Similarly, there is one more subcategory which is mid cap mutual fund. This fund is benchmarked against Nifty mid cap 150. So in this mutual fund, only mostly mid cap stocks are selected. And then third, this large and mid cap mutual fund category. So in these mutual funds are benchmarked against Nifty large and mid cap 250 index. So this is a picture from SEBI website, uh, and this sets the rules for all these categories of mutual funds. So you can see for large cap funds, it is mandated to invest in a mostly in large cap companies for at least 80% of their total assets. So you can read this document for more details. So in our analysis, we have not considered the expense ratio of all the actively managed mutual funds. And the data source that we have used is we have taken the NAV value from MF tools. This is GitHub library for mutual fund codes. It is very good resource to get historical NAV, and mostly for all mutual funds NAV is available from 2013. You can see from this picture, just by writing some 2-3 lines of code, you can get all the NAV values, historical NAV values from 2013. One point to note here is mutual funds are denoted by these 6-digit codes, and they have also provided the list in which for each of these codes their mutual fund names and their AMCs and their subcategories are listed. In this analysis, we will be looking at 5 years SIP rolling returns. Unlike earlier cases where we have considered a longer time frame for our comparison, but in this case, since our historic data is available only after 2013, so we have no option but to choose a slightly shorter time frame, so which is 5 years in this case, to compare our performance of all our mutual funds. One thing to note here is all these benchmark index, the data we get is price return index, but so this is a picture from the actual fact sheet of Nifty 100 index from NSE website. What it says is the price return for the Nifty 100 for last 5 years was 15.5%, but the total return is 16.82%. The difference comes from the dividends that these 100 stocks has given in the last 5 years. So total return represents the price movement as well as dividend income, and price return represents only the price of the constituent stocks. So this is the first plot where we are comparing all the 20 large cap actively managed mutual funds with their benchmark, that is Nifty 100 TRI. It's a complete mess. Actually, we cannot see anything because they are so close to each other. Note that these are SIP returns, not CAGR returns, and we are looking at the time from 2018 to 2024, approximately 6 years. This is very limited time with respect to the goal timelines. So we have earlier seen that the long term is anything about 12 years. So we have to reanalyze this data once we have enough data at our hand, means after few more years. But even in this available data set, let's highlight only the benchmark to see how many of them actually beat the benchmark. Now this is much better. You can say, you can see at any given point there are some mutual funds which are above the benchmark, and you can see it throughout the time. You can say many of them considerably beating the benchmark as well. But here we are not interested in rare outperformance of mutual funds, but we want a consistency. So what we desire from our mutual fund is it should beat the benchmark consistently. So let's see that information. You will be surprised to see 0 out of all the 20 large cap actively managed mutual funds able to beat the benchmark more than 90% of the time. Only 3 of them able to beat the benchmark more than 80% of the time. Now, why this consistency is required? To understand this, let us consider an example. Imagine in 2019, you wanted to invest in a large cap mutual fund. So you looked at this data and found one mutual fund who has beaten the benchmark considerably, and you started a SIP in that mutual fund. But after 5 years, in 2024, you found out that that mutual fund which you selected has underperformed the benchmark. That is something we don't want. So that is why this consistency is most crucial in order to compare the performance of actively managed mutual funds. In large cap case, we see all 20 large cap mutual funds are not able to beat the benchmark more than 90% of the time. Now let's see the case for mid cap mutual funds. Here as well, you can see at all the times, most of the times, there are some mutual funds who are giving excess returns than benchmark. But if you look at the consistency levels, so only one out of 17 mid cap funds able to beat the benchmark more than 90% of the time. And our third category was large and mid cap funds. And here as well, only one out of 15 large and mid cap funds able to beat the benchmark more than 90% of the time. And I am not interested in these names, so you can just try to search these codes in MF tools. You will get to know the names of this mutual fund. But the point that I'm trying to make here is there is a severe underperformance of more or less all actively managed mutual funds in these three subcategories. And in fact, we have not considered the expense ratio of these mutual funds. So if you factor that in, there will be even more chances of underperforming the benchmark. So it is very clear from this data that actively managed mutual funds are not consistently beating their benchmark. Now, if you see this trend, then you may think instead of investing in actively managed mutual funds, why not just invest in the benchmark itself, which is more or less consistent? Is there any way? Yes. And that is where we bring up our next section, that is index funds, also known as passively managed mutual funds. Now let's first understand what are available broad-based NSE indices. If you rank the stocks listed on NSE on the basis of their free float market capitalization, and then you took only top 50 stocks. It and if you create an index for them, then it is Nifty 50 index. Similarly, I'm listing down all the indices that we are considering for our analysis. So this is Nifty Next 50, also known as Nifty Junior Nifty, which constitutes rank 51st to 100 stocks. Then this is Nifty 100. This is up to 100. The stocks are called large cap stocks. So this consists of rank first to 100, top 100 stocks basically. Then there is Nifty Mid Cap 150. So from rank 101 to 250, these stocks are included in this index. And then we have Nifty Large and Mid Cap 250 stocks. So this is basically a equal weighted average of Nifty 100 and Nifty Mid Cap 150 stocks. Then we have Nifty 200. So this index consists of top 200 stocks. Then we will also consider Nifty Small Cap 250. These are the stocks from rank 251 to 500. And finally, we will have Nifty 500 index, which consists of top 500 stocks listed in the NSE on the basis of free float market capitalization. Now note that these index, their constituents are market cap weightage based. What does it mean is on the basis of their market cap, their weightage is decided. So even if within, let's say, in Nifty 50, the stocks which market capitalization is very high, their weightage is also higher. Now this image represents all these indices correctly. Now if you plot 15 years SIP rolling returns for Nifty 50, and now let's overlap other indices on this plot. Now, orange is Nifty 100, green is Nifty 200, and red one is Nifty 500. So if you see, more or less all these four indices more or less follow the Nifty 50 path only. There is no considerable variation, and only in the case of Nifty 500 we see there is some deviation from Nifty 50. If you plot this in the form of box plot, it makes then more sense because we have these values. First let me explain what does it mean. So mu is average value, that is mean value, and sigma is standard deviation. So what is desirable case? If we have higher mu and lesser standard deviation. So we want index which is giving on an average higher returns, but their variation in returns should be as low as possible. If you compare these four index, more or less they are giving same return in the range of 11 to 11.5%, and more or less their standard deviation is in the same levels. The reason for this similar performance is because the top stocks in all the indices are highly skewed. So I'm just listing out the weightage of top 10 stocks in all this index. So you can see the case for Nifty 50. The top 10 stocks are taking 35% of the weightage of out of 100%, and remaining 490 stocks are represented in remaining 65%. So even if you plot these four indices and calculate the correlation of this with respect to Nifty 50, it will come more than 0.095. So basically they are more or less represent Nifty 50 only. So takeaway is Nifty 50 correctly more or less represents all these four indices. So in case you have option to choose one index out of these four, you can anyway select Nifty 50 or Nifty 100 because more or less these four will give same level of average returns at same level of variation in the returns. Now let's bring in the junior Nifty with respect to Nifty 50, and here you see a clear cut overperformance or above the Nifty 50 level in all the possible points that we have seen in this plot. Nifty 50, next 50 has given better returns than Nifty 50. In case of mid cap 150 and small cap 250 index, this gray plot represents Nifty mid cap 150, and this color represents small cap 250. And now let's bring junior Nifty as well here. So here you see a small cap 250 index is not even beating the Nifty next 50 or Nifty 50 index. Now this plot represents SIP returns, 15 years SIP rolling returns for Nifty 100, Nifty large cap, Nifty mid cap 150, and their weighted average. So as by definition, Nifty large and mid cap 250 is weighted average of their parent index. So their returns are also more or less in between these two indices. Now let us represent all these cases in box plot format. Now, if you compare Nifty 50 with Nifty Midcap 150, you see Nifty Midcap 150 has given on an average 4% higher returns than Nifty 150. The second observation, Nifty Large and Midcap 250 is exactly in between Nifty Midcap 150 and Nifty 50, or more or less Nifty 100 as well. Now you say the interesting case for Nifty Small Cap 250. Nifty Small Cap 250 is not giving is giving less returns than in fact Nifty Next 50 and Nifty Mid Cap 150 as well. An important thing to note here, it is having highest variation, means the spread of the returns from small cap 250 is very high. So even if it is slightly giving better returns than Nifty 50, it does not make sense to use this index for our investment. And that is the reason we have not chosen the small cap 250 category in our earlier actively mutual fund analysis. The takeaway from this comparison is, if you have option to choose for your investment, do not consider small cap 250 index as an option for your investment. If you want mid cap exposure to your investment, you can definitely consider any of these two, that is mid cap 150 or large and mid cap 250. And if you want slightly excess returns with large cap constituents, with large cap only, then you can choose Nifty Next 50. Now these are the plots which compares their mutual funds with their equal weighted index. So equal weight means instead of unlike Nifty 50, when all the stocks are market cap weightage based, but here all the stocks have same weightage. So in Nifty 50 equal weight, all the stocks have 2% weightage. So you can see here, almost half of the time equal weight index beat the Nifty 50, but in second half it is not able to beat the Nifty 50. Same case with Nifty 100 and Nifty 100 equal weight index. So if you plot them in box plot format, so you see more or less they give same return with same level of standard deviation. In fact, if you go to the fine detail level, you see Nifty 50 has given more returns with less standard deviation with respect to the Nifty 50 equal index, and same observation for Nifty 100 and Nifty 100 equal weight as well. The takeaway from this plot is, if you have option to choose Nifty 50 or Nifty 50 equal weight, then always choose Nifty 50, because equal weight index does not seem to give extraordinary returns and is not reducing risk as well. Now let's analyze strategic NSE indices. Now, a good thing about these indices are they are designed on the basis of some quantitative models or investment strategies. You can read more details on this link. huh? and and even though they are launched lately, they are back calculated from the base date. So for example, let's say one strategic index is launched on, let's say, year 2018, but due to the definition is in the format of some mathematical model, it can be back calculated, let's say, from year 2006 or 8. So we have enough data to evaluate all these strategic indices on the basis of 15-year SIP rolling returns. Now let's understand the name of this strategic indices by this example. Now this Nifty 200 represents the parent Nifty index. Then the term alpha represents the quantitative model used in this index or investment strategy used. So in this case, it is alpha. So alpha is basically, if we rank the stocks, all 200 stocks based on Jensen alpha score, and then if we select top 30 of them, then that represents Nifty 200 alpha 30 index. That is how this strategic index is defined. So similarly, instead of alpha, let's say there was Nifty 200 momentum 30 index. Then the top 200 stocks were arranged on the basis of their 6-month and 12-month price return. And then top 30 were selected. Similarly, quality and low volatility are two other quantitative models based on which strategic indices are created. So once this is clear, then let us analyze what are available strategic indices in NSE. This is the first one. Here I have taken Nifty 200 and their available strategic indices for comparison. You can see all the three strategic indices are consistently beating the parent index, and especially the Nifty Momentum 30 and Nifty Alpha 30 are means the difference is constant throughout the time frame that we are considering. You can see Nifty 200 is giving average 11.2 returns, but you see the excess returns given by all these strategic indices. For example, this Momentum 30 is giving almost 5% excess returns at same level of standard deviation. Means the variation in the returns is same like its parent index, but it is giving excess returns. See this case of Nifty 200 quality. It is slightly giving less returns. So in average returns wise, it is in between 200 and momentum, but on the risk side, it is having low variation in the returns. So which is most desirable case? The desirable case for us is it should beat the, so average returns should be high, and the standard deviation, the sigma value, should be less than its parent index. So by which we will get higher returns without compromising or in fact increasing the risk in the, so reducing the risk in our returns. So similarly, if we plot Nifty Midcap 150 strategic indices, here as well, Momentum 50 strategy has clearly seen to be beating the index by considerable margin, almost by 7% difference is there in case of Midcap 150. But the midcap 150 quality 50 strategic index has initially outperformed the parent index, but in the last this region especially, it has not performed well. Now here, if you see a clear outperformance of their parent benchmark by almost 7%, which is huge, and without change in the expected return. So standard deviation is same in these both cases. But the point that we have to consider that we have compared this for very limited time frame for this analysis, and these were based on back calculated values. So we have to give more time for our analysis to, or for our observations to get more confidence. So we have to reevaluate this in future as well. Now, the last category in this strategic indices is for Nifty 100, where we have compared performance of Nifty 100 low volatility 30 index and Nifty 100 alpha 30 index. So here as well, both the strategic indices have beaten their parent benchmark consistently for all the times in the time frame considered. And if you look at in the form of box plot, this is very desirable case for us. That is Nifty 100 low volatility 30. See, it is already selecting stocks from Nifty 100, that is large cap. It is selecting low volatile stocks. So by definition, it should reduce the return risk. So as by definition, it is giving less variation. So risk is reduced, but counterintuitively, it is giving us on an average higher returns than their parent index. So see, it is giving 2% higher returns than parent index. So this is completely counterintuitive. We have always been told that high risk, high rewards, but this is that one exceptional case where we are getting higher returns with less risk. And finally, we put all our analyzed all our indices till now in single plot, where this black box represents the broad base index, this green box represents the strategic indices, and you can compare all of them in one go to make your observations on the basis of the return metrics, average return metrics, and the risk, that is standard deviations. But note that we just compared different indices, and still it is not clear how we can invest in them, right? So is there any options available? And if yes, how accurately they follow the reference index? So this brings us to the next section of our analysis, that is index mutual funds, or also known as passively managed mutual funds. Now in this section, we will look at what is index mutual funds and also known as passive mutual funds. Now in terms of method, the active mutual funds, the fund manager actively changes the fund's composition at his or her own discretion. But in case of passive mutual fund manager only follows the composition from the benchmark index without any discretion. So it may happen uh, that let's say fund manager is changed, then that particular mutual fund performance may get changed over the time. But in case of passive mutual funds, the performance exactly will be same as their benchmark index, since there is no discretion. In terms of expense ratio, active mutual funds expense ratio is anywhere between 0.3 0.4% to 2.25%. But in passive mutual funds, there is a maximum cap set by SEBI that it should not be more than 1%. And in general, actually, it is on very lower side of, let's say, 0.3 0.4% with respect to active mutual funds. On return side, in actively managed mutual funds, fund manager aims to beat the benchmark, or I would say at least try to beat the benchmark. But we have seen from our earlier analysis, you know that as well, how many of them actually able to beat the benchmark. So I will not comment anything more on this. But in case of passively mutual funds, their returns are exactly or more or less very close to the benchmark index. Of course, there are some tracking errors, but the the returns are very close to the benchmark index returns. Now in this plot, we are comparing SIP rolling returns for 5 years for Nifty 50 TRI, that is total return index, and what are available index Nifty 50 index mutual funds. So firstly, there are very less mutual funds available. Secondly, we have very less data to compare, and even with the less available data, it feels really good to see all the available index funds tracking their benchmark, that is green line, with the almost zero tracking error. So you see, the index mutual funds basically exactly tracks their benchmark, which is quite evident from this plot. Now there are some recently launched index mutual funds based on strategic indexes as well, but I have not considered this in our analysis for two reasons. First reason is, as I have already said, in strategic indices are back calculated, and these mutual funds have recently launched, so we have very limited data. So we have to wait for some few more years to able to analyze and compare them in terms of their returns. Now let's summarize what we have seen till now. First thing, CAGR returns are deceptive. For Nifty 50 rolling returns for 15 years, difference between CAGR and SIP returns is anywhere between -7% to as high as 5%. So it makes sense to compare investment instruments like mutual funds on SIP basis rather than CAGR, for especially for retail investors like us who invest on monthly basis. Then we looked at how long the long term really mean in mutual fund investments, and we got the answers: at least 12 years. Then we checked effectiveness of this 15-15-15 rule. On paper it works beautifully, but in reality it is very difficult based on the past returns that we saw and based on the average holding period of mutual fund units. Then we saw there is no special date for starting a SIP. Returns in long term will remain same irrespective of SIP date. Then we looked at performance of actively managed mutual funds with respect to their benchmark, and what we found out was 0 out of 20 large cap mutual funds, 1 out of 17 mid cap mutual funds, and 1 out of 15 large and mid cap mutual funds able to beat the benchmark more than 90% of the time based on 5 years rolling SIP returns. You can pause the video and read it again. But in general, most of the actively managed mutual funds not able to beat the benchmark consistently. That is the takeaway. And finally, we analyzed various NSE indices and index mutual funds. In that, we found out index mutual funds seems to be promising, but it gives clear idea of what returns and variations to expect at lower expense ratio, but at the same time, they need more investigation in upcoming years. Having said that, we have covered almost everything. It feels like we have covered almost everything about mutual funds. But I feel still we are missing elephant in the room. And that brings us to the next topic. Now this is the last small but important topic that we are discussing in this video. That is why, how and what. I think you all have known this golden circle of framework by Simon Sinek, where why is the core purpose. In our case, it is financial independence. Then comes how. So how represents the processes and strategies you need to achieve the core purpose. So in our case, there will be emergency fund, insurance, retirement corpus, and many other things. These are the strategies by which we will meet our purpose, core purpose, that is financial independence. And in the last comes what. What are the tangible products by which we will implement these strategies? So see the priority. First one is why, that is core purpose. Then comes how, that is strategies. And in the last, that is third, comes the what, that is tangible products. And in our case, that will be bank FDs, term or health insurance, mutual funds, stocks, etc. If you set this in this correct framework format, then this model will give us confidence, conviction, and clarity for every investment decision that we are making. So if you find this useful, do give it a try and put your thoughts in this format, and I am sure it will definitely help you. And finally, welcome to my channel. This is short introduction to my YouTube channel. Channel name is Adi Vimarsha. I have just started this channel purely as my hobby, where I would like to discuss on many topics, and personal finance is one of them. So today we discussed purely from data driven point of view, and we list down all the observations for mutual funds, and there will be more upcoming topics as well. So please share your honest feedback in comment section, and please subscribe, like, comment and share. Thank you.